Silver prices have surged to unprecedented levels above $77 per ounce in late December 2025, driven by tightening global supply and escalating industrial demand amid structural deficits. This rapid ascent reflects Beijing's implementation of stringent export licensing requirements, effectively constraining outflows from the world's dominant producer and refiner. As inventories dwindle and physical premiums widen, vulnerabilities in Western manufacturing sectors reliant on silver for solar panels, electronics, and electric vehicles are acutely exposed. The move prioritizes domestic needs while reshaping market dynamics, amplifying costs across green energy transitions and high-tech supply chains. With deficits projected to persist and alternatives limited, immediate risks of production disruptions and elevated input prices threaten economic competitiveness, particularly for import-dependent economies navigating renewed trade barriers. In the evolving landscape of global commodity markets, where industrial demands for critical materials intersect with geopolitical strategies for resource security, China's impending imposition of export licensing requirements on silver represents a calculated escalation that tightens supply from the world's preeminent producer and refiner, with immediate ramifications for international inventories and pricing structures. As of December 28, 2025, with the new regulations set to take effect in mere days on January 1, 2026, Beijing's Ministry of Commerce has mandated that all silver exports necessitate government-issued licenses, confining eligibility to large-scale, state-approved enterprises meeting stringent production thresholds of at least 500 tons annually and demonstrating robust credit profiles. This framework effectively curtails outflows that have historically constituted 60–70% of global silver supply, as China commands a dominant position in both mining and refining, processing a substantial share of the metal essential for high-tech and renewable applications. The policy emerges amid persistent multi-year market deficits, surpassing 200 million ounces annually, driven by surging domestic consumption in solar photovoltaic manufacturing and electronics, where China's internal needs now absorb over 50% of global industrial demand. Economic imperatives underpin this shift, prioritizing retention of strategic resources to fuel indigenous growth in clean energy and advanced technology sectors, while market reactions have already propelled silver prices to record highs around $79 per ounce, reflecting acute physical shortages and widening premiums on international exchanges. This development unfolds against a backdrop of intensifying U.S.-China trade frictions, where reciprocal tariffs and controls on related materials amplify vulnerabilities in global supply chains, compelling a reassessment of dependencies for economies reliant on imported silver. The origins of this regulatory tightening trace to a decade-long pattern of resource nationalism in China, where silver, classified increasingly as a strategic commodity, has been subject to progressive oversight to align with national development goals. Beginning in the early 2010s, Beijing implemented environmental reforms in mining operations, consolidating production under state-owned entities like China Minmetals and Zijin Mining, which by 2024 accounted for a significant portion of the country's 3,300 metric tons of output, making China the second-largest producer globally after Mexico. These measures, embedded in the 14th Five-Year Plan and extended into current frameworks, emphasized value-added processing, with China refining over 60% of worldwide silver concentrates, transforming imported ores from Latin America and Australia into high-purity products for export. By 2022, export quotas were informally calibrated to domestic surpluses, but escalating deficits, reaching 215 million ounces in 2024, prompted a pivot toward retention, as photovoltaic demand alone consumed 161 million ounces globally, with China's solar industry absorbing the lion's share amid its dominance in panel production, exceeding 80% of world capacity. The 2025 announcement, number 68, from the Ministry of Commerce formalizes this approach, requiring exporters to submit detailed applications disclosing end users and volumes, with approvals granted selectively to firms demonstrating alignment with national priorities, thereby reducing speculative outflows and ensuring supply for internal ecosystems. This licensing regime, restricting participation to entities with verified production scales and financial stability, mirrors controls on rare earths and graphite, where similar mechanisms have maintained Beijing's leverage in critical minerals since the 2010s. As the restrictions loom, their immediate effect is to constrict global supply channels, where China's historical exports, averaging 1,502,000 tons annually, have buffered international markets against mining shortfalls. With global mine production stagnating at around 830 million ounces in 2025, reliant on byproduct output from copper, lead, and zinc operations, the curtailment exacerbates a fifth consecutive structural deficit, projected at 115-120 million ounces for the year, depleting above-ground stocks to perilously low levels equivalent to mere months of industrial consumption. Domestic priorities drive this. China's electronics sector, encompassing semiconductors and consumer devices, demands over 100 million ounces yearly, while solar deployments, targeting 600 gigawatts of new capacity in 2025, require silver paste for efficient conductivity, pushing total industrial offtake to 59% of global demand at 1.12 billion ounces. Economic logic here favors internal allocation to sustain export-oriented manufacturing, where silver's role in photovoltaic efficiency underpins Beijing's carbon neutrality commitments by 2060, avoiding bottlenecks that could derail growth in a sector contributing 10% to GDP. Market behavior has responded swiftly, with futures on the Shanghai Gold Exchange surging 169% year-to-date, while physical premiums in London and New York have widened to 5–10% above spot, signaling acute scarcity for fabricators outside China. This tightening manifests in disrupted inventories, as major vaults report drawdowns exceeding 50 million ounces in the fourth quarter, compelling buyers to source from secondary recycling, which covers only 20% of supply and faces logistical constraints amid elevated energy costs. The consequences of this policy extend deeply into global industrial ecosystems, where silver's irreplaceable conductivity and reflectivity underpin applications from automotive electronics to defense optics, inflating costs and straining timelines for dependent manufacturers. In the United States and Europe, where domestic mining yields less than 10% of needs, the restrictions amplify input price volatility, with silver-intensive sectors like electric vehicles requiring 0.305 ounces per unit for wiring and sensors, facing margin compressions as costs rise 150% over 2025 levels. Geopolitical analysis reveals how this dovetails with broader trade decoupling, as U.S. tariffs on Chinese solar imports redirect demand pressures without alleviating supply constraints, potentially delaying renewable transitions critical for net zero targets. For instance, photovoltaic installations, forecasted to consume 20% of silver supply in 2025, encounter procurement hurdles that elevate panel prices by 5–8%, cascading into higher energy costs for consumers and industries. In electronics, where silver enables high-speed data transmission in 5G infrastructure, shortages could impede rollout in emerging markets, widening digital divides while favoring Chinese firms with preferential access. These disruptions erode competitiveness, as Western companies stockpile at premiums, diverting capital from innovation and contributing to inflationary pass-throughs estimated at 0.20% in core goods indices. Hidden risks in this unfolding scenario center on prolonged deficits that amplify market volatility, forcing reliance on higher-cost alternatives and exposing systemic fragilities in supply-dependent industries. With recycling rates plateauing at 180–200 million ounces annually due to collection inefficiencies, and new mine developments lagging by 5–7 years amid environmental permitting delays, the restrictions could entrench deficits through 2030, projecting cumulative shortfalls exceeding 800 million ounces. This volatility manifests in speculative trading spikes, as evidenced by 2025's 170% price rally, potentially triggering hedging failures for unhedged producers and fabricators, leading to production curtailments in silver-intensive operations like aerospace sensors or medical devices. Geopolitically, the policy enhances Beijing's leverage in negotiations, mirroring rare earth strategies where export curbs in 2010 prompted international diversification, efforts that remain incomplete, risking bifurcated markets, where access favors aligned partners through Belt and Road agreements. For economies like the U.S., hidden exposures include defense vulnerabilities, as silver underpins radar and missile systems, with stockpiles offering limited buffers against sustained restrictions. Broader interconnections with China's resource strategies reveal a cohesive approach to securing industrial dominance, where silver controls complement dominance in rare earths, over 90% of processing, and precious metals accumulation, including gold reserves surpassing 2,300 tons. This synergy bolsters financial resilience amid de-dollarization, as elevated silver prices support yuan-denominated commodity trades, reducing exposure to U.S. financial infrastructure. In clean energy, the policy accelerates internal self-sufficiency, potentially shifting global solar supply chains further toward Asia, while Western diversification initiatives, like the U.S. Critical Materials Act, face hurdles in scaling alternative sources from Australia or Peru, where infrastructure investments lag. As December 28, 2025, marks the eve of implementation, intelligence priorities must encompass monitoring export license approvals and inventory flows, as any further escalations could precipitate nonlinear price movements, reshaping alliances and economic trajectories in a resource-constrained world. The immediate imperative for strategic planners is to evaluate hedging mechanisms and multilateral procurement pacts, mitigating risks that this tightening poses to technological sovereignty and macroeconomic stability. In the contemporary global commodity arena, where the imperative for sustainable energy transitions collides with finite resource availability and geopolitical maneuvering, the explosive surge in industrial demand for silver from photovoltaic solar manufacturing and electric vehicle production has decisively outpaced supply capabilities, engendering persistent structural deficits that threaten to disrupt key technological advancements and economic equilibria. As of December 28, 2025, global silver consumption has attained unprecedented heights, with total demand eclipsing 1.2 billion ounces for the year, propelled predominantly by industrial applications that now constitute 59% of utilization, a proportion amplified by the rapid proliferation of renewable energy infrastructure and electrified transportation. Photovoltaic manufacturing alone has absorbed over 20% of available supply, with silver's critical role in conductive pastes enabling efficient energy conversion in solar panels, amid installations that have expanded global capacity by 600 gigawatts in 2025, driven by policy commitments in major economies to achieve net zero emissions. Compounding this, electric vehicle output, surpassing 25 million units globally, has intensified silver requirements for electronic components, wiring harnesses, and battery management systems, where the metal's superior conductivity ensures operational reliability, contributing an additional 35% annual growth in automotive demand projected through 2031. These converging demands have precipitated annual market deficits exceeding 120 million ounces in 2025, marking the fifth consecutive year of shortfalls, as mining output stagnates due to geological constraints and byproduct dependencies from base metal extraction, depleting above-ground inventories to multi-year lows equivalent to mere weeks of industrial consumption. Geopolitical overlays, particularly Beijing's export licensing regime effective January 1, 2026, further exacerbate this imbalance by redirecting supplies toward domestic priorities, amplifying price pressures that have driven silver valuations to record levels around $79 per ounce, reflecting year-to-date gains surpassing 150%. This unfolding disequilibrium not only underscores vulnerabilities in clean energy supply chains, but also poses systemic risks to macroeconomic stability, as elevated costs cascade through high-tech sectors essential for climate mitigation objectives. The escalation of industrial demand traces its roots to the mid-2010s, when global commitments under the Paris Agreement catalyzed investments in renewable technologies, positioning silver as an indispensable enabler due to its unmatched electrical and thermal properties. By 2016, photovoltaic demand consumed approximately 80 million ounces annually, but aggressive subsidies in China and feed-in tariffs in Europe propelled this to over 160 million ounces by 2024, with 2025 witnessing a further 15–20% uptick as solar module efficiency improvements, reaching 25% in advanced heterojunction cells, necessitated higher silver loadings per panel to optimize current collection. Concurrently, the electric vehicle sector's maturation, fueled by regulatory mandates such as the European Union's 2035 internal combustion engine phase-out and U.S. Inflation Reduction Act incentives, has elevated silver usage from negligible levels in 2015 to over 50 million ounces in 2025, with each vehicle incorporating 0.305 ounces in switches, sensors, and power electronics. A figure projected to rise with the integration of autonomous driving systems, requiring enhanced computational hardware. This dual thrust has transformed silver from a primarily investment and jewelry asset, historically accounting for 40% of demand, into an industrial staple, with total consumption climbing from 886 million ounces in 2016 to a forecasted 1.2 billion ounces in 2025, outstripping supply growth constrained by the metal's status as a byproduct of copper, lead, and zinc mining. Where output is tethered to base metal economics rather than silver-specific incentives, mining production stabilizing at around 813,840 for million ounces in 2025, despite marginal increases from projects in Mexico and Peru, faces inherent limitations from declining ore grades, averaging 1–2% lower annually, and environmental regulations that extend permitting timelines to 5–7 years, curtailing responsive expansions amid surging requirements. Recycling efforts, contributing 180–200 million ounces yearly, have plateaued due to inefficiencies in urban mining and the long life cycle of silver-embedded products, further entrenching deficits that have cumulatively eroded stocks by over 800 million ounces since 2021. The photovoltaic sector's voracious appetite exemplifies how policy-driven expansions have outrun supply elasticity, with China's dominance in solar manufacturing, producing 80% of global panels, absorbing domestic silver output to meet export targets under the dual carbon goals, while international deployments in India and the Middle East add incremental pressure. In 2025, solar demand alone has exceeded 200 million ounces, a 25% increase from the prior year, as bifacial modules and perovskite tandem cells demand denser silver grids to minimize resistive losses, achieving conversion efficiencies beyond 28% in commercial applications. This growth trajectory aligns with International Energy Agency projections for solar capacity additions reaching 650 gigawatts annually by 2030, implying silver requirements could double if substitution technologies like copper plating fail to scale economically, given silver's superior corrosion resistance in humid environments. Similarly, electric vehicles have integrated silver into battery chemistries and charging infrastructure, where high-voltage systems rely on the metal for contactors and fuses to handle thermal loads, with global EV sales surpassing expectations at 18% market penetration, driven by cost reductions in lithium iron phosphate batteries that nonetheless incorporate silver-enhanced components for durability. These sectors' compounded demands have rendered supply-side responses inadequate, as primary silver mines, representing only 30% of output, struggle with capital allocation in a base metal downturn, where copper prices have moderated amid construction slowdowns, indirectly capping silver byproduct volumes. Geopolitical factors intensify this mismatch, with Beijing's export controls redirecting refined silver toward internal priorities, reducing global availability by an estimated 50–60% of previous export levels, thereby funneling material to China's EV ecosystem, which produced over 10 million units in 2025, and solar farms integral to energy security strategies. Market consequences of this imbalance are manifesting in sustained upward trajectories for silver prices, which have escalated beyond $79 per ounce, yielding year-to-date appreciations exceeding 150%, as futures contracts on the Shanghai Gold Exchange and COMEX reflect hedging activities by industrial consumers anticipating prolonged shortages. This pricing pressure has translated into physical premiums surging 5–10% above spot in Western markets, compelling fabricators to curtail operations or pass costs downstream, with solar panel prices rising 5–8% in the fourth quarter, potentially delaying utility-scale projects in regions like California and Germany, where subsidies are fixed. For electric vehicles, elevated silver costs contribute to battery pack expenses, increasing by 2–3%, eroding margins for manufacturers like Tesla and BYD amid competitive pricing wars, while broader inflationary impulses filter into consumer electronics, where silver's use in semiconductors and displays adds to chip fabrication burdens already strained by parallel shortages in rare earths. The depletion of above-ground stocks to critical lows, estimated at 200–300 million ounces globally, has heightened volatility, with intraday swings amplifying as speculative positions in exchange-traded funds absorb retail inflows seeking exposure to the clean energy narrative. Geopolitically, export curbs not only redirect flows, but also incentivize resource nationalism in producer nations like Peru, where community disputes have idled operations, further constraining output and favoring integrated chains in Asia over fragmented Western dependencies. Hidden risks inherent in the structural deficit revolve around potential rationing in high-tech applications, where silver's unique properties defy easy substitution, elevating costs that permeate supply chains and impede pivotal transitions to sustainable technologies vital for addressing climate imperatives. In scenarios of protracted shortages, photovoltaic manufacturers may resort to thriftier designs, reducing silver content by 10–15% through busbar optimizations. Yet this compromises efficiency, potentially inflating levelized costs of energy by 3–5% and delaying global decarbonization timelines. Ali. Ned with 1.5 degrees Celsius pathways. For electric vehicles, rationing could manifest in delayed model launches or scaled-back production targets, as seen in tentative adjustments by European automakers facing input volatility, exacerbating range anxiety concerns and hindering adoption rates necessary for transport sector emissions reductions. Broader economic perils include amplified inflationary pass-throughs, where silver-intensive industries contribute to core price indices rising 0.20%, constraining monetary policy flexibility in major economies amid lingering post-pandemic recoveries. Geopolitical escalations, such as intensified US-China decoupling, could trigger reciprocal measures on alternative materials, bifurcating global markets and favoring resilient, vertically integrated players while disadvantaging import-reliant entities, with cumulative deficits projected to exceed 800 million ounces by 2030 absent breakthroughs in recycling or mining innovations. These vulnerabilities extend to defense applications, where silver underpins radar and communication systems, risking operational degradations in contested environments. This demand-supply asymmetry interfaces with parallel trends in critical minerals, where silver's trajectory mirrors challenges in lithium and cobalt, amplifying leverage for producer states and necessitating multilateral frameworks like the Minerals Security Partnership to diversify sources. As 2025 concludes with deficits entrenched and prices elevated, intelligence imperatives demand enhanced surveillance of inventory metrics and policy announcements, as any further curbs could precipitate nonlinear disruptions, reshaping investment landscapes and strategic priorities in a resource-constrained paradigm. The confluence of these factors underscores an urgent recalibration for policymakers, emphasizing accelerated R&D in alternatives and stockpiling to safeguard transitions integral to long-term prosperity. In the intensifying arena of global resource dependencies and economic decoupling, the sharp escalation in silver prices, now surpassing $79 per ounce as of December 28, 2025, directly inflates input costs for key U.S. industries, including electronics, defense, and renewables, thereby eroding competitiveness and precipitating wealth erosion in sectors heavily reliant on imports for this critical material. Domestic silver production in the United States, which amounted to approximately 1,100 metric tons in 2023, according to the latest available U.S. Geological Survey data, covers only a fraction of national needs, with imports constituting over 80% of consumption, primarily sourced from Mexico, Canada, and Peru, leaving American manufacturers exposed to international supply fluctuations and pricing volatility. This cost escalation, amid a broader commodity supercycle driven by industrial demands, compresses profit margins across value chains, contributing to persistent inflationary dynamics in finished goods that could add 0.20% to core producer price indices in the coming quarters. Geopolitical frictions, particularly with China, the dominant global refiner controlling over 60% of processing capacity, amplify these vulnerabilities, as recent export licensing requirements effective January 1, 2026, favor resilient domestic networks in Beijing while restricting outflows, thereby redirecting supplies away from Western buyers and underscoring the strategic asymmetries in critical materials amid ongoing bilateral tensions. The immediate consequences manifest in diminished export competitiveness for U.S. firms, with potential delays in strategic initiatives such as semiconductor fabrication and solar energy deployment, where elevated material expenses could inflate project budgets by 5–10%, hindering compliance with domestic content mandates under the Inflation Reduction Act. Hidden risks extend to broader wealth effects, including higher consumer prices that strain household balance sheets and investment reallocations that pressure silver-intensive portfolios, highlighting entrenched dependencies in an era of economic decoupling that demands urgent diversification strategies. The trajectory of silver's valuation surge traces back to structural shifts in global demand patterns, beginning in the early 2020s when renewable energy mandates and electrification trends accelerated consumption beyond historical norms. By 2023, global industrial silver demand had reached 654 million ounces, with the United States accounting for approximately 15–20% of this through its advanced manufacturing base, yet domestic mine output, primarily from operations in Alaska, Nevada, and Idaho, hovered at around 1,110 metric tons annually, insufficient to meet escalating requirements in high-tech sectors. Imports, valued at over $5 billion in 2024 per the Observatory of Economic Complexity, have bridged this gap, but with prices climbing under $30 per ounce at the start of 2025 to current levels near $80. The cost burden has intensified, particularly for electronics manufacturers, where silver's conductivity is integral to circuit boards, connectors, and soldering alloys. In the defense domain, silver's applications in radar systems, missile guidance, and electromagnetic shielding consume substantial volumes, estimated at tens of millions of ounces globally, with U.S. military procurement facing amplified expenses that could redirect budgetary allocations from research to sustainment, as evidenced by recent analyses suggesting military usage may exceed other industrial categories in scale. Renewables, particularly solar photovoltaics, represent another acute vulnerability. U.S. installations, targeting 100 gigawatts in 2025 under federal incentives, rely on silver paste for panel efficiency, with each gigawatt requiring roughly 200,000 ounces, translating to import-dependent cost spikes that elevate levelized energy expenses by 3–5% amid the price rally. This historical buildup, compounded by mining constraints, where U.S. production declined 1.63% in 2023 due to ore grade depletion and regulatory hurdles, sets the stage for current pressures as geopolitical overlays, such as China's export controls, exacerbate import reliances, forcing American firms to navigate higher premiums and logistical delays. As silver valuations maintain their upward momentum, with forecasts from entities like the Silver Institute projecting sustained highs into 2026, potentially reaching $100 per ounce driven by persistent deficits, the direct inflationary impact on U.S. industries becomes increasingly pronounced. In electronics, where global consumption approached 445 million ounces in 2023 and continues to grow with AI data center expansions requiring silver in thermal management and interconnects, American semiconductor producers, already contending with chip shortages, face margin erosions of 2–4% as input costs for silver-based materials rise proportionally, potentially deferring capital investments in domestic fabrication facilities mandated by the CHIPS Act. Defense sectors, reliant on silver for precision optics, avionics, and hypersonic weaponry, encounter procurement challenges that strain the Pentagon's $886 billion fiscal 2025 budget, with escalated material expenses contributing to overruns in programs like the F-35 Joint Strike Fighter, where electronic subsystems incorporate silver to ensure signal integrity under extreme conditions. For renewables, the cost escalation imperils the Biden administration's clean energy agenda, as solar developers grapple with panel price increases of 5–8%, delaying utility-scale projects in Sunbelt states and compressing returns on investment that could otherwise accelerate grid decarbonization. Broader commodity pressures, including parallel rises in copper and rare earths, amplify these effects, fostering a compounding inflationary environment where producer prices in durable goods sectors, encompassing electronics and machinery, have risen 1.52% quarter-over-quarter, feeding into consumer price indices and constraining Federal Reserve policy options amid a soft landing trajectory. Geopolitical frictions serve as a multiplier of these vulnerabilities, as restricted access to silver flows, exemplified by China's January 2026 licensing regime limiting exports to state-approved entities, prioritizes Beijing's domestic solar and EV ecosystems, which dominate global production at over 80% and 60% respectively, thereby favoring resilient supply networks insulated from Western tariffs. This asymmetry, rooted in ongoing economic decoupling since the 2018 trade war, exposes U.S. industries to asymmetric risks, where import-reliant sectors like defense electronics, sourcing 70% of silver needs from abroad, face potential allocation shortfalls during escalations, as observed in simulated wargames highlighting material bottlenecks in Indo-Pacific contingencies. The U.S. International Trade Commission's 2021 review of minerals and metals imports underscored this reliance, with silver's strategic importance amplified by its dual-use nature, prompting calls for enhanced stockpiling under the Defense Production Act, yet current reserves offer limited buffers against prolonged price surges. In renewables, geopolitical tensions manifest in supply chain disruptions, as U.S. solar firms, importing modules despite domestic assembly incentives, confront higher costs that erode competitiveness against subsidized Chinese competitors, potentially stalling the transition to 50% renewable electricity by 2030. These frictions not only inflate immediate expenses, but also incentivize investment shifts toward alternatives like aluminum or graphene, though technological maturity lags, prolonging dependencies and underscoring the strategic imperative for multilateral alliances to secure diversified sources. The consequences of this cost inflation extend to diminished U.S. export competitiveness, as higher input prices cascade through global value chains, rendering American products less viable in international markets. In electronics, where the U.S. holds a 20% share of semiconductor exports valued at over $60 billion annually, elevated silver costs contribute to price hikes in end-user devices, eroding market share against Asian rivals with integrated supply access, as evidenced by recent trade data showing a 57% decline in U.S. tech exports to Europe amid commodity volatility. Defense industries, exporting systems worth $150 billion yearly, face competitive disadvantages in bids for allied procurements, where inflated material bills could add billions to contract values, deterring partners like NATO members from U.S.-sourced equipment in favor of cost-effective alternatives. For renewables, delays in solar deployment, projected to add 40 gigawatts in 2026, undermine energy independence goals, as higher costs defer grid modernization and expose utilities to fossil fuel price swings, with knock-on effects on manufacturing hubs reliant on affordable power. Strategic initiatives, such as the semiconductor resurgence under the CHIPS and Science Act, allocating $52 billion, risk timeline slippages if silver shortages constrain foundry operations, while solar incentives under the Inflation Reduction Act, targeting $1 trillion in clean energy investments, could see reduced efficacy if material inflation absorbs subsidy benefits. Hidden risks embedded in this dynamic encompass broader wealth effects that permeate consumer markets and financial portfolios, straining balance sheets and amplifying systemic fragilities amid decoupling. Higher consumer prices, as silver-intensive goods like smartphones and solar installations pass through costs, estimated at 1–2% increases in retail electronics, erode household purchasing power, contributing to wage price spirals in an economy where core inflation lingers above 2% targets. Investment reallocations pose additional perils, as silver-intensive portfolios in mining equities and commodity funds face volatility, with exchange-traded funds witnessing outflows during price spikes that could trigger deleveraging in leveraged positions, echoing stresses in 2023 banking episodes. These effects underscore dependencies in critical materials, where U.S. import reliance, exceeding 90% for refined silver, invites strategic coercion in trade negotiations, as China's controls mirror past rare earth restrictions that prompted 501,000% price surges in 2010, wiping billions from Western industrial value. In the context of ongoing decoupling, risks include fragmented global markets, where access bifurcates along alliance lines, favoring economies with robust domestic production while disadvantaging the U.S. in high-growth sectors like AI hardware, where silver's role in data centers could delay expansions critical for technological edge. This unfolding cost escalation intersects with parallel macroeconomic trends, including de-dollarization efforts and commodity hoarding, where elevated silver prices bolster Beijing's reserve diversification, gold holdings now over 2,300 tons, while diminishing U.S. leverage in financial diplomacy. As 2025 concludes with silver deficits entrenched at 115–120 million ounces and forecasts signaling further gains, intelligence assessments must prioritize supply chain audits and policy simulations, as unmitigated exposures could precipitate nonlinear wealth transfers, estimated in the hundreds of billions through inflated imports and lost productivity, reshaping competitive landscapes in a multipolar order. The imperative for countermeasures, enhanced recycling incentives, bilateral sourcing pacts, and technological substitutions, grows acute, safeguarding strategic interests against these mounting pressures.